gonna start the show. I have not told anybody, so whoever showed up will show up, you know. So I'm not gonna play the music today. It's kind of a little bit short on time. So I'm gonna stay here for maybe 45 minutes. So that's my goal. So we'll see. So right off the bat, obviously we need to look at the price action. This is how it's gonna go. Every single time I cover this, have to cover the price action, right? So of course today we end the trading day at 1725, and I kind of know that because remember when I show you the option, the volume, it was around this resistance line right here. 1750. That was the call option that has 23,000 contracts. And so with that, no, not 23. There were a lot more. I have to go back to you could go back to yesterday's live stream, and you might find out what the unusual call options was, and it says 7 that was in the money. If it was in the money, it would have been, hopefully those people would have been exercising it, and the market maker would have had to go out to the market to buy it, you know. So I think that's why it was kept under 1750. How long can they keep it this under? Who knows, right? Technically, they could do anything at this point. But my next level is this line right here. I'm hoping that it's going to fall as a support right there. 1625 or 20 or so, right? Currently there's no news, there's no catalyst quite yet until the earnings report. But it could run before that even. So when was let me show you. Elano, thank you for joining. I know I didn't play the music today, but I was running short on time. So, but yeah, I appreciate you showing up. But anyway, so what was I saying? Let's see. So the report running up to last quarter 4, reporting was right here. So this is the quarter 4. So we know that quarter 4 is the best quarter for GameStop, right? GameStop usually reported end of fiscal year, and about 30 to 40% of the sale comes from quarter 4. So kind of closer to 30%, not the 40%. But my point is that the volume might get picked up again right after the reporting. Depends on what it does, right? If you look at the estimated report, estimated kind of number that Wall Street was looking at the previous year was 2.18. And they end up beating earning by 2%, or top line revenue by 2%. But the earnings part was the massive amount of beating right there too. So if we were to be more enthusiastic about the way, or the annualized inflated number for the next earning, can we do twice as much, right? So 200%. I think that's twice as much, right? So 50%, 50 cents per share earnings. That's possible, and hopefully we beat on the top line revenue too. So, and this earning is pretty good, right? If you look at the earnings report right there, it's to 100% beat right there. That's massive, by the way. I feel like that should not have been 100%. I feel like it should be more, right? Because they were estimated 8 cents. Shouldn't it be like more than 100% here? Unless I don't know how they report that, how they come up with 100%, because it beats by 8 cents per share. So anyway, I mean, all in all, it's still good earnings, right? Now they might try to bring it up to like a lot higher right here. And so just be in the lookout for, I mean, the next resistance, if you were to look into, well, first we have to beat that 1750 first, right, in order to get to the next level, which is around 1944 right there. And all it is just the previously high number right there. So that's how I got the number from, you know. So that's that. No matter what the news is, I feel like it's market mechanic at this point, because they could run anything up at will. So it seemed, right? And also they could increase engagement based on other stock price or other company, right? And in one of the company that I mentioned there, of course, GME, we know what that is already. What is the reason behind this? You mean the run up? Or the search in volume? I don't know what you mean by that. So, but anyway, so we watched this guy before, but of course, like, I want to show this part because it's kind of like, why are they trying to steer people away from GME? We all know this, right? So, hold on. Let me come back to this because it's kind of like a better point right here. I'm gonna go on the run up. So the run up, we don't know what the run. I never seems to know, but I feel like I could speculate why the volume just all of a sudden surge. Well, there's a couple of things, right? There's, the option chain, right? And number one. Number two, it's the Fed decision, right? We all know that the Fed decision really doesn't align with whatever they're telling you. So it's almost like it's the reason why he's up there to speak is just to kind of like say stuff and not really do it, right? Or to trying to steer, not instill fear, but more like give guidance, right? That's what they always say. Oh, hey, we're data dependent. We don't want to do anything to cause any catastrophe. What's not, like, but to me, they don't have any choice. The reason why the rate went lower is because of the bond market. Has nothing to do with the Fed decision whatsoever. The decision, like he said, it's data dependent, right? So when I'll explain it later. I think I have a, hold on. Hold on. I think I have bond yield right here. Bloomberg. Which one was the one that shows? Yeah, this one. Okay. Oh, I didn't put that on there. I used to, but never mind. I was gonna go live earlier, but I got distracted and computer got shut down for some reason. Hi, Anthony. Thank you for joining. So, but anyway, so I was just talking about like the bond yields and all that stuff. But let me finish my thought here first. So we've seen this guy before, right? And we were kind of talking about why are they trying to steer people away from GameStop, and and it's almost like comical at this point. If you really look at his facial expression, anytime he talk about, I'm not going to play the sound, so to speak. I just want to show you the facial expression. Anytime they talk about GameStop, it's almost like an angry face type thing, right? And then it's always like the tone is always, it's a terrible company, don't touch it, and find another company to own. And curiously, obviously, what company is he trying to tell you to buy? So can you guess? I think you've seen this one before, but just look at how he described GameStop, right? Look at this. It's almost like, what the hell? But anyway, and then of course he was like, oh, back away slowly and then find another company. And then look at it. Look how happy he is. So he's trying to pump, look, Dollar General, right? We all know this. Dollar General is a terrible company in my opinion, and we know this from Marantz, right? If you look at let's see, I should have had it up right here. I'm sure you've seen this one before. Is it this one? No. Give me a minute. Right here.
Plenty of good information. A little bit more.
Just in case somebody missed Moran's, I'll just play
Motivation, a whole lot of truth, no financial advice. This is a one-take session. No edits, no cuts, about private equity, leverage buyouts, you name it. It's called Connect the Dots Part 40. This one's a little special to me, and I'll tell you why. So about 3 days ago, there's this guy named Little Man Finance, Strong Man Finance. Yes, I get it. He was paid $50 to make a video about me, just to make fun of me, and or to tell me how unvaluable GameStop is. He's like, no, it's not real. It's gone. It's dead. Okay, bro, we get it. You go read the numbers, and you're wrong, by the way, and you will be. You'll be proven wrong in 180 days. It's okay. I'll still be here. But I see now that on my feed that I watched your video, I got fed a video. It says he's going to do a video on Dollar General. And I go, well, okay, good for him. They're going bankrupt. Okay, good for him. Hey, check it out. Little Man Finance. Check this out. So you think that my theory about private equity and connect the dots is all nonsense and it's not real. Okay, so I'm going to help you make the case for it because I know you're going to do a video on it, right? That's what you're going to do. All right, cool. So I'm going to show you how they're going bankrupt without even showing you the chart, without even showing you the balance sheet. And then you tell me if I'm crazy. All right? Let's do it. So this is your chart. It's trash. And when we look at it, this is Dollar General. They went public, if you guys don't know, went public in 2009. And when they went public, it was because KKR bought them in 2007. Now, them going public is one thing. Pumping the stock and now dumping it, it's going to get worse. And I mean a whole lot worse. We're talking about offering shares to the public. They're going to go ahead and sell off their assets and lease them back. They're going to do everything. They're going to run this bad boy through the ground. And you know why they're going to do it? Because the family that started this company started like 80 years ago. 90, everybody's gone. It's all private now. It's all private equity. That's all it is. Publicly traded company. You people, the individuals who think this is a great investment are putting money into it, but it's never coming back. And I'll show you why. Let's go. I think I'm ready. I'm always ready. If you stay ready, you ain't got to get ready. So first, we'll look at the balance sheet right here for you before we even get to the good stuff, okay? I'm only showing you one page. This is going to be their senior notes, money borrowed. $7.2 billion money borrowed. And the reason why I'm okay with that is because you have to remember what KKR said. And this is Henry Kravis, their actual leader. He says, hey, always borrow money. Borrow money at any time you can. Just keep borrowing money. Doesn't matter if the rates are high or low. It does not matter because you can always refinance later and or move the money later. Just stay alive, survive. That's what he said. But before we even get to this, I want to show you something. This is Connect the Dots Part 17.
So yeah, I'm not gonna finish the whole thing, but that was debt for Dollar General, and I think it's fitting that this guy who have a disdain, for GameStop, trying to push you to buy into this company right here. And I forgot what he said. Let's listen in.
I think so. I love this thing at 100 right before Vassos came back. It's run up a little bit. Let me just tell you, I kind of regret I didn't just jump in a little bit earlier a few months ago. But here's the thing. They'll get the inventories down. I love the pop shelf stores. They got about, I think, 300 or 400 of those out. They look cool. It's more about little goods and little things to buy. I think people don't understand this company. It's a tough business. However, the PE is so cheap compared to its other competitors. Also, they've got the new, CEO back that's making people feel comfortable. But this is not something that has a moat. This is like the only game in town. I live in New Mexico. We have a lot of rural areas where a lot of people don't have gas money to drive 25 miles to a Walmart. They got $3 in their pocket and they need some things like toothpaste and necessities, and Dollar General provides that. So I think that people don't understand that as long as they can make the stores a little safer, that's an issue.
All right, we got to go.
Well, of course, right? Dollar General is the buy when you have this massive amount of debt. And if you look at statistically, right? Let's look at it together. I might have shown you this already, but insider ownership, look at this. Less than 1%. Institutionally owned, of course they're going to pump it to you. 91% institutionally owned. No shorted shares. Okay, well, institutional owns all of it, so therefore nobody wants to short this, right? If you look, PE ratio, of course, it's over 10, so that therefore it's kind of overvalued for retail, right? If you look at the book value, not too bad at 4 times its book value. Net income, close to $2 billion right there. That's fine, but look at the debt. Total debt right there, right? I'm sure that $7 billion is included in that too. So that's concerning part. But here's another concerning part. It has almond score, Z-score of under 3, right? And if you read further down here, anything under 3 is increasing risk for bankruptcy. So they want to push you to buy or to sell GameStop if you have it. If you don't touch it. But yet, go ahead and buy into this company that has all of those little stores out there that you could buy toothpaste and all that stuff. Profit margin, I guess it's kind of razor thin, right? But GameStop is even lower than that, so I can't knock them right now for that. But to me, GameStop is infinitely much better, right? Because they have no debt. If you look at the financial here, go to the balance sheets, trailing 12. I wonder how much they actually have to make in order to interest payment. I think, what should I? Retaining loss. Well, at least they earn $2.5 billion so far. That's a good thing. At least they're not accumulatively losing money yet, right? Shareholder equity right here, 6.4 right there. But if you look at goodwill, I bet you anything it has some goodwill. Look at the goodwill value. You see this? Anytime you have goodwill value of $5.5 billion, but then the shareholder equity is only 6, what does that mean? If you were to minus it, the book value would not have been 4. It would have been higher because technically you only have a shareholder equity of $1 billion, even less than that if you were to subtract the goodwill value. And then on top of that, what do you have? Long-term debt. Look at the long-term debt, $16 billion. And this guy wants you to buy into this company. When Moran's, hold on, total debt. Yeah, when Moran's make that video, how long ago was that? 2 months ago. So from 7.2 to now, what is it? Freaking 15 billion? Now, maybe that's like a cumulative. If you look at this, see, look. I think this is when they add that $7 billion right there. You know, from 2.8 to 9.9 right there. So that's the $7 billion. And then since then, they've been adding more. Now it's at close to $16 billion. And this guy wants you to buy into this stock. So again, I mean, I hope nobody's listening to this guy. And again, why are you trying to steer people away from GameStop? I mean, it's curious too. But anyway, I mean, I hope nobody listened to him and listened to this network right here. Time and time again, you know, I'm not saying that they're always telling lies, but I'm saying that anytime they push you to do something, check first and then come to your own conclusion later. So that's just my opinion, or stated by facts, right? Okay, that's that. So let's talk about NVIDIA, right? And this is another thing too. You know, all of a sudden it is the cheapest stock to buy. And it's at what? $1.2 trillion market cap. And there's more room to run, according to the analysts out there, right? It is a strong buy right now, and it could go up to $1,100. So they say. The average price should be at around $600 a share, which is like around $1.5 trillion market cap, right? If that's what to be the case. I don't know. Is there anything founded in that? Well, let's take a look at it together. I'm not saying this is a terrible company by any means. I'm just saying that it's overvalued, way overvalued, right? But, you know, people are not rational, because these type of big institution, they move markets, and they could let anything run, you know, and suppress anything they wanted to, you know, so to speak, if they have the ability to. If enough people are gullible enough to follow them, right? So, with NVIDIA, actually, they have better insider ownership than AMC, right? Than Apple, even if you look at Apple, you know. So at least there's some insider ownership in that. Of course, institutional ownership is high. Look at the float. I mean, you're telling me that 2.3 billion shares can be moved in, you know, 5-6%, like, you know, because it's allowed to be moved that way. It's allowed to run up that way. So it takes an enormous amount of money, billions of dollars, tens of billions of dollars, to move NVIDIA up to whatever, you know, it's at right now. I wonder, hold on, let me see if I could find a chart here so I could show you a little bit better. It's kind of ridiculous at this point. Hold on. Corp. I think it's this one. Why is it? This one. So if you look at this candle right here, that's 46 million shares right there. 46 million share at $488. What is that? Nominally, if you look at the billions of dollars, how many billions of dollars to move to move it up to that. Hold on, let me see. From here to here, that's 2.2%, right? But if you look at the low here, I think that's within a week or so, 9%. 9%. That's a lot of money to move, NVIDIA, a large cap company, this high at a shorter period of time. My point is that, they want it to run. They wanted to let it run, and then they're going to dump on. So this is what I'm referring to. Let's listen in.
Welcome back to Fast Money. Stocks closing out at a historic week of gains. The Dow ending Friday at a record high, locking in its longest weekly winning streak since February of 2019. The S&P ending the week up 2.5% despite today's slight pullback, and the Nasdaq rising up 3% for the week. DocuSign shares surging nearly 12% after the Wall Street Journal reported that the software company is exploring a possible sale. The stock is still down 80% from its all-time high. Well, Bernstein Research reiterating its bullish call for NVIDIA today. The firm believes NVIDIA is the cheapest AI stock, which may sound counterintuitive. Shares are already up 235% so far this year and trading less than 3% from an all-time high. Bernstein's Stacey Raskin is behind that NVIDIA call. Stacey, great to have you on the show. Welcome.
Good to be here. Good to be here.
It does sound you think of NVIDIA as being the hottest AI play around, but yet when you take a look at forward valuations, it's actually trading cheaper than basically many, if not all of its peers at this point.
It really is. And so, yeah, it feels a little weird to complain about a stock that's more than tripled year to date, right? But while that's happened, like stocks up a bunch, forward earnings estimates over the last year are up, I don't know, they've quadrupled, they're up 4x or something. The multiple's actually been cut by 2/3. NVIDIA today is trading under 25 times. It hasn't traded there since the crypto bubble burst in the end of 2018. And it's actually at a discount to the overall semiconductor industry. The stocks is at 26 times. That hasn't happened since 2014 when there was no data center story. It is, in fact, the cheapest on a forward earnings basis, the cheapest of all the stocks that you would think about as AI plays, AMD or Intel or maybe Marvell. NVIDIA's at 25 times. Intel's at like 26, if you can believe it. Marvell's, I don't know, 30 or something, and AMD's over 40 times earnings. If those forward numbers are really, again, that's the worry. We can talk about that. But on the current sort of, consensus estimates that are out there on a forward basis, NVIDIA is actually the cheapest of the AIs, and it's even cheaper than the broader semiconductor industry as a whole. Yeah.
Have we learned any? I mean, AMD has had a massive run in just the past, week to 10 days or so. Is there anything that we learned about AMD's product lineup that makes you think that perhaps money should go into AMD and that rally and that boost to the multiple is warranted?
Yeah, so let's talk about so why is NVIDIA so cheap? Because it feeds into that question. It's cheap because people are worried that the numbers are getting so big so quickly. You just worry about sustainability. And, I'll make it up. Like the sell side's at $20 in earnings or something for NVIDIA next year. And I think the buy side's closer to 25. And I think the worry is, they'll do 25 next year. And then maybe the year after that, they'll do 15, right? There's a worry that there's an air pocket out there. AMD in context, they did something that was smart. They've latched onto this AI story. They've got products that look reasonably credible. And they've given guidance that there's room to go up. I mean, they said they'll do more than $2 billion of revenue, AI revenue next year. I mean, that number could be 3 or 4. It's a rounding error, right? Like if NVIDIA does 70 billion next year, that will be viewed as disappointing. So AMD has kind of left themselves room, and people have been migrating to that stock as sort of a way to play AI with maybe less perceived air pocket risk. Now, whether that's justified is a whole other question. It's very, very expensive, but I understand why it's had the move that it has.
So, Stacey, when you look at NVIDIA, they have, I think it's 80 to 85% of the market. And correct me if I'm wrong on that market right there. But Melissa always says it's theirs to lose. Yes. Is this just sands through an hourglass right now, waiting for them to lose that market share? Is it AMD the closest runner up there, or is this going to be spread around where we're going to have to figure out what the peripheral stocks to play off of the?
I mean, there's a number of different competitors. So there are the other merchant suppliers like AMD or Intel, and AMD, to their credit, has a roadmap with products on it. Intel, we could argue. There are players like the hyperscalers, like Google and the like, that are doing their own chips. That is not new, actually. Like Google's been doing their own for 8 years. And in fact, they're quite a bit larger, I think, than anything you'd even see from AMD. But it's only a piece of that store if you were going to buy one of those stocks. There's also a bunch of startups, which it's just really hard to get scale. I would say it's NVIDIA's game to lose, but what I like about NVIDIA is they are not like laying back and getting fat, dumb, and happy, right? They're continuing to push the envelope. They're investing. They're actually shaping the market. And they've actually, they're accelerating their own product roadmap. So anything that's even out there today, even if we're competitive, it's not going to be competitive for long. NVIDIA's got their next generation, it's called the H200. That launches in Q2 of next year. They've got an entirely new architecture. It's called Blackwell. That launches in the second half of next year. This is a moving target. And NVIDIA, to their credit, they are continuing to push that. If they screw something up, I mean, sure, but they haven't screwed anything up yet.
Yet? No? Not yet? You sure about that? So I'm not going to finish the whole thing. Now, To me, I just think that, you know, the whole NVIDIA thing, scandal, the fact that they only like reporting a forward, there was some scandal surrounded their reported on the orders that has not been even put on. Like they put the balance sheets on the order that has not even been completed yet. So they have not delivered the goods, but they put it on the balance sheets anyway. The whole problem with that is that this person or this entity who bought that from them could cancel at any time. It's like, hey, I only want half of that order, and then now you have to revise your revenue. And you know, the run up that warrants that one was this one right here, the earnings. I think like $1 billion, or was it this one? The $13 billion one. Yeah, if you read this report right here, quarter two, I think. Yeah, from June. Yeah, quarter two. Or three, hold on. Quarter two, sorry. So this is a quarter two, and if you were to read this particular report, you would see that, close to 10% or more than 10% of our revenue is not realized yet, or something like that. They put it in the balance sheet, but yet the the stock just keep going up too still, because, you know, it reported as beat earnings. Look, top line revenue by 20%, and then by 30%. So that's the news that was kind of give rise to that increase. And then, yes, year on year, obviously or quarter to quarter, they have been increasing their revenue, but much of that was overinflated. You know, it's based on revenue that hasn't been completed yet. So again, there's a risk of canceling, you know. Hi, Jay. Thank you for joining. I appreciate you. Just talking about how overpriced NVIDIA is. But, you know, if you look at the technical, I bet, you know, there are people who think that this is a bullish indicator because of what? Look at I saw somebody do this drawing earlier, and then boom, right? It's just the whole classic bounce, rebound type of thing, right? And maybe that's the last hurrah here, you know. I guess if you do a bull flag here, you could kind of draw this flag right here, and then do this, right? I don't know. I'm just an amateur here. That's the next price target, right? Is that why the analysts out there, they want you to buy into it? And what's the price target for this guy here? Let's see. $609. So let's see. So close to that, right? And so I guess that's where they get it from. The fact that the technical is kind of supporting the bullish case. But again, it's just the technical. It has nothing to do with the fundamental, right? Yes, they beat earnings, but come on, what? Like, how many sales do they do in a year? So revenue in a year is $40 billion. That's pretty good. But let's look at the financial here. I bet you anything, they probably have a lot of goodwill. So cash on hand, that's pretty good. Short-term investment. Oh, looks like they increased by is it trailing 12? Yes. $2.7 billion. $2.5 billion worth of, I bet it's about marketable security here. So they do have a lot of marketable security, or some sort of short-term investment thing. That's good. At least they have some cash on hand there. Inventory, it seems like it's been up, right, from here to here, quarter to quarter. Perhaps it's just to getting ready for the Christmas sale. If you look at the previous quarter right here, it seems like they didn't even, they they didn't sell much for the fourth quarter of last year. So is that a concerning thing? We'll see, right? Perhaps they're different type of cycle here. Manufacturing chips, they do it a different cycle of business, so to speak. It seems like quarter 2 is the one that kind of like the lowest inventory in terms of dollar amount. So that's that. So I'm looking for goodwill right here, of course. Look, $5.6 billion is goodwill. The way I look at this is that if you were to subtract this by this, or subtract the number over here, then shareholder equity is actually lower than that. $33 billion. So that's going to decrease the book value right there. But keep in mind, though, the book value here is $13, even at the overinflated price because of the goodwill. So 13 divided by the whole share here. As far as equity-wise, you don't get much for your money if you were to buy into NVIDIA, right? So shareholder equity is only 2%. So say 3% just to be generous here. So if you were to buy that, you get 3% equity versus 30% for GameStop. It's probably a little bit less now because of the price going up. No goodwill value, the best leadership ever, right? So we know that. What else? If I look at we did the inventory already. Let's see, debt. The amount of debt that is being accumulated by this company. Look, close to, well, at least they pay down a little bit year on year. But this, from last year to this year, or from this quarter to this quarter, they have added about $100 million right there in the debt department. But it seems like they've been paying off kind of slowly. That's a good sign. At least they're addressing that. But the fact is, they still have the debt, man. Like that's not good. Yeah, I mean, they're not in immediate danger, obviously. I'm just saying that it's a ton of overvalue. So if you look at the PE ratio right here, 64, you guys. And then the forward, and that's why the Lisa Lee there, which she was saying, like, even the forward PE ratio, it's even lower than any other ones. As if that's a good thing. No, because currently it's a lot higher than the forward PE ratio. So what does that tell me? It tells me that in the future, the company cannot out-earn it. You see what I mean? But that's just my opinion here, right? Again, if they are able to increase their top line revenue, because that's what Wall Street cares about, I guess. If you brought in more revenue year on year, okay, great. But can you sustain that? Look, from 10% to now 56%, up from one quarter to the next. And so can that business sustain itself? Eventually, you're going to get a lower, revenue, like this, for example, a 12% drop out of nowhere because it's coming from the high. So give me a minute. But anyway, and then if the stock price keep going up and up, eventually when they have a disappointing earnings, not because they don't make money, but because of from the high, the stock will be violently coming down as well. And this is kind of fitting because now they're just pumping it up so that you could buy it at a higher price, a higher valuation than anything else. So I don't know, if you want to buy into it, that's on you. Just do your own research here. So we did talk about the Dollar General already. Let's see. Sofi. So I talked about this before where what I've noticed is that, on the feed here, if you were to look at Sofi, it seems like they've been pumping it up as well. And not only the media, but also people who are, talking about, it was live earlier and I saw like it was 600 people in there. But look at the view, only 3, right? So what gives? I should have make a snapshot, but now this woman have been talking about Sofi for quite some times now, but it seems like it's more often. And of course, this guy, Financial Journey, but he did it on another stock or another channel here. Of course, if you watch Moran's, you know who that person is, trading trending stocks. So he's pumping Sofi as well. There's a lot more engagement lately, it seems. Of course, look, could they squeeze and whatnot? The same narrative as GME, right? Short squeeze, they have to cover, whatnot. But for some reason, they don't ever mention GameStop, right? Curious. Here's another one. 1 hour ago. So just be on the lookout for that type of pump. But here's one talking about GME. Who is this guy? Never seen this guy before.
In this video, let's talk about GameStop stock. I entered in some call options as I alerted on the Discord, link in the description.
Wow.
We have been absolutely killing it. Sofi 32%, we made a video on here. Upwork, which was on our weekly watch list video, up 70%. Yep. And many other plays. Make sure to join the Discord, link in the description. Psychology and the analysis.
Robinhood.
So we will be talking, and it's going to easily go to.
All right, check them out if you want to. I wouldn't. Now, call option. Yes, you could make a lot of money, but you're gonna lose most of the time. If you play call option on GME, unless you know when they're gonna run it up, I wouldn't touch it. Right. That's just me. Don't get me wrong, I do play a call option, once in a blue moon if I feel that I want to lose some money, right? No, I'm kidding. If I feel like, hey, this makes sense, I would do it. And I would always close it, like at 15%, 20%. I know I shouldn't, but if you want to play call option, you want to wait at least, 3 months ahead of time. And even then, you might be wrong too. You might lose a whole bunch. But anyway, that's that. Thank you so much for joining, by the way, you guys. All right, so, I was going to show you the Russell 2000 actually. Russell 2000, usually it's a mid-cap, right? IWM or whatever, if you want to say it that way. It's kind of all the same thing. And this is the ETF that has mostly, not mostly, like the most percentage of GME. And this is where they short it too. And so now this gentleman here, Mike, just talk about Russell 2000. It's due for a run up, right? So let's listen in and I'll come back later.
Okay, talk about leprosy. That's what this thing has had for a while. It trades different than any other index out there. This is the RUT, right? So U.S. Small Cap 2000 Index. It has been down 33% since 2022, right? Just trading in this range at the bottom. And this is what it likes to do. I'll show you. It likes to trade in this range, okay? It's a great swing trade, by the way. And when you look at this, we drew the fibs. Well, look at this. It hadn't even retraced. Well, when you look at this, it hadn't even retraced 50% from the drop yet. Remind you, look what all the other indexes are doing, right? So this thing still has to hit its July high at this point in time. Matter of fact, I don't even think it's hit its January high. So we still get the January high, then go back to 2022 and hit the July high, hit those levels. But again, if you can get to the 50% retracement or even the golden pocket, let's say the golden pocket, that's only 9%, right? So we're not even talking about it. And then 2,500 gets you back to where you were at. That's a 23% move. All right, so I'm just talking about that. I mean, and understand, I'm going to show you some examples of how long it normally takes for this thing to get back there. It doesn't trade like any other index, okay? This was 2020, and you can see it respects the fibs, and look how long it took. I mean, takes a long time to move up right here in 2020. I mean, it took a very long time. And these moves down, you see, these are big moves as it's moving up. These are 10 to 12% moves, multiple times while it's moving up, okay? You look over here, there's, I'm talking about trade in a range for a long period of time. Again, here's.
Now, when he said like longer period of time, look at the time frame. It's under a year. That's not that long. So he's going to show you a whole bunch of things. If you want to watch that video, go ahead and kind of search his name right there. Mike Jones, if you want to. He's very knowledgeable, you know, talking about markets and stuff like that and chart and what's going on in the bond markets, whatnot. Oh, see, look at this one. So
late? Don't fucking say I'm late. I'm not late. I'm here. What are you talking
is this a live one?
Oh, we're here.
No, it's not a live one. Sorry.
Hey guys, Mike here.
It was live earlier, but that's why. So, but anyway, so it's just to show you that we're due for a run too, because this has GME in it. And perhaps it's going to take another 6 or 7 months for this to kind of like come to fruition, going back, tracing back to that all-time high again, or all-time high, the previous high. So that's the whole point of that, of me showing you that one. Yeah, it's getting close to my mark here. But before I let you go, oh, I was going to show you this one. Let me go through the bond market first, though. So currently, you have the 3 months right there. Is paying higher than the the 30 years here, right? So the shorter leg of the bond got paid higher. Was it inverted yield curve or whatever? It just go to show that in a minute, this right here, in 6 months, 6 months later, this rate might not be locked in that way, right? And so if the 2 years right here were to cross, were to get to under this right here, 10 years, that's is usually when S hit the fan, right? So to speak. So let me say that again. If you have a 2 years lower than the 10 years, that's usually when people will chase the 10 years, right? And money will exit out of the stock market, so to speak, right? And the idea is that if you think about like large institution, right? Why would they want to chase something that is like lower than 4%, right? Why are they, what is it called? Why are they satisfied with only like 4% if the stock market's gonna rally, right? Again, this is a 10-year horizon here. So they're predicting something ominous happening within that 10 years. We just don't know when, or they might not know when. And they may have seen something that we can't see because of the data, that they have access to that we don't. And so that's why the bond market, when straight, especially the 10-year one, kind of like traded down 1 basis point in a day. It just means that they're chasing that yield. And more of them are chasing it. That's why when when people are, it's kind of counterintuitive. So when people want the treasury bill, the yield would just keep going down, but the value of the price of the yield went up. So like this dollars now, it's what, Now it's you know, to get it, you have to pay more for it, so to speak. But to get a lower yield. And so just look at this, like anytime you see the 2 years going down lower than the 10-year, that's when people are going to lock in, you know, and this rate right here won't stay at that high anymore. How long it's going to be like that, we don't know, until the market began to sober up, right? And now there's another concern too, before I show you the other, is that Jim Cramer. Jim, for those of you who don't know who Jim Cramer is, he's notorious at, you know, telling you what to do at the wrong time, right? So currently, let's see, what did he say? Recession is not coming. So if he say that, what do? You run for the hill type thing, right? Again, this guy tell people not to take money out of Bear Stearns. 2 weeks later, it dumped, right? So now, if he's saying that the market is going higher, buy the stock, any stock that you can, the recession is not coming, soft landing is here, just be wary of that, right? So just prepare yourself. All right, so let's end with this video right here. This guy is a really, I don't know, I like his style of video. And since some of you don't have, you know, Twitter, I'm going to show you in full here. Let me kind of speed it up a little bit. So it's only 7 minutes here. But I'll end it here and I'll come back after the video, though, just to say bye.
As far as I'm aware, there's exactly nothing by choice. When you ask Google if there's any CEOs that don't get paid, it spits out this hilarious list, including Elon Musk and Larry Ellison and Steve Jobs. Or you can find articles from people like CNBC claiming that Mark Zuckerberg gets paid $1. I've made enough money, he said during a Facebook Q&A back in 2015. He just doesn't need any more money, which is why last year he took home $27 million. Or you got Musk, the highest paid CEO in all of human history, it's because his stock value went up so fast, but they made a pay package in 2018 that's now worth $50 billion. Bunch of controversy there. Just to clarify, that's billion with a B. Or Larry Ellison of Oracle, more than $5 million in total compensation, more than $4 million of that in cash bonuses. That's just a bonus. I have no idea how Meg Whitman snuck onto Google's list, like $35 million. I mean, even selfless old Steve Jobs took home $1 million a year. Any of you real ones out there know who I'm talking about? I'm talking about this. Oh wait, wrong photo. I'm talking about this guy. Oh shit, wrong photo. This guy. Oh god damn it. There he is, handsome bugger. This is Ryan Cohen. And if you didn't know, he's the CEO and chairman of Gamestop. And when he was just the chairman of the board, he was already choosing to take home no compensation in cash or stock awards, which is super rare. Plus, it's worth noting he became the chairman because he bought in with his own money to the tune of millions and millions of dollars and took over the company with his own money. Then he chose to receive no compensation from his work other than the appreciation of his own shares that he bought with his own money, because if he does well at the company and the company does well, then his shares will go up in value and so will everyone else's. Then, this year, he became the CEO as well and chose to receive no compensation of any sort for that role. That's just one of many things you probably don't know about GameStop, because it never ended. Despite what bot accounts on Reddit that wanted you to get out of there and forget all about it might have been paid to repost prolifically, and despite someone literally paying to advertise during the whole situation that the hedge funds closed their positions, because you really needed to know that the hedge funds closed their positions. I mean, you were probably told that some sort of short squeeze happened, except that if you read the SEC report about the GameStop situation in 2021, you might have noticed that they explicitly said a short squeeze did not appear to be the main driver of events. It continues on the next page, and a gamma squeeze even less likely. Or you would have seen this chart in the report where the SEC backed that claim up with their proprietary data that we don't have access to, where they showed in red that short sellers buying back the stock while the stock was at its highest values in the dashed line here was basically non-existent. Remember, like more than twice as many shares as existed short sold leading into this before they suddenly changed how it was reported, and suddenly the short interest came down to only 22%, which is considered extremely high. That's today. This is like a screenshot from 3 days ago. It's still at 22%. Even once whatever happened with their reporting happened with the reporting. Like, to be clear, Most short squeezes happen with short interest between 10 and 30%. This is like really high. But I'm not telling you to buy any stock. I'm just filling you in on some shit that you might not have known. And this rabbit hole goes way deeper than this. I'm gonna make some long form videos about it because there's a lot more interesting things to know about this. Like, for example, GameStop, according to Yahoo Finance, held by insiders is 12% of the stock is held by insiders. That's basically all Ryan Cohen, the chairman and CEO, with his own money. And only 28% of the stock is held by all institutions like BlackRock, Vanguard, State Street, Morgan Stanley, all the big banks. So who holds all the shares? Well, according to GameStop's most recent SEC filing, the hardcore GameStoppers that never sold their shit and have directly registered their shares in their own names, meaning they took them out of the market so short sellers couldn't borrow those shares, they hold a whopping 25% of the company. This is me. I'm a part of this number. I am directly registered, and I have no intention of selling them ever. Like, you might not realize how unique this number is. We own collectively way more of this company than all institutions combined. Like, that does not happen. Amazon, between the insiders and the institutions, that's like 70%. Microsoft, 73%. Google, 62%. Apple, 60%. Robinhood, 73%. And Best Buy, 83%. I mean, y'all already know that the big institutions own everything. At least they own everything except for GameStop. Because despite what some of the documentaries you might have watched about it wanted to claim and make it seem like, most of us never sold. Actually, we bought and bought and bought and bought. Like, it's kind of hilarious how much people bought after the short squeeze. Like, this is Fidelity data on buying and selling from an average month in 2022, 2021, 2023. Green is how many people are buying, and red is how many people are selling the stock. Like, certainly, what happened in 2021 was fucking awesome, and it was super cool, and if you don't know the story, you should go learn about it. But what happened with GameStop since 2021 is where the real story lies. Because it was after the short squeeze in 2021 when everyone started to dig into the corruption in the financial markets, and they started to uncover a lot of things that the financial markets do not want you to know, and the people with all the money that were on the other side of this trade do not want you to know. What they all found out is a huge part of why I am here doing what I do. It is long past time that I make a video about what really happened in 2021, and more importantly, what happened since 2021. So this is just a little teaser. There's infinite more funny shit to talk about, and a lot of dirt, and one really cool chairman, and an awesome company. And I'm gonna make a few more short form videos on this, assuming that I don't get my account banned for this for weird reasons. And I'm definitely gonna make a full length YouTube video or 2 or 3, who knows? Because this shit goes deep. And before the entire financial markets collapse for whatever reason in 2024, it's important that you know what the GameStop people figured out, because it's all connected. And I by no means speak for everybody in the GameStop community. It is a vast and complex story, and I'm just one dude. I'm not an expert at any of this, and I'm just an idiot that's been following along as best I can. And it's been hilarious. You've been holding the stock along with us. You're a legend. I love you. And if you don't know what I'm talking about, stay tuned. More coming up. Hold up, this video is not quite the right length yet, so I got a spicy clip for you before we go.
It's just a little bit too convenient that you got Melvin Capital losing billions of dollars, Citadel backing them, and then 2 days later, Robinhood stopping people from buying it. If that's what's happening, they all are in bed with each other, which is scary.
But there will never be any proof, right? Because no one's going to own up to a hedge fund colluding with...
Proof? Yeah, maybe not proof. But evidence? And there's a lot of evidence of things. Of all sorts of things.
Yeah, I hope you enjoy that. I hope the sound was kind of high too, because I don't know why it's so low. But anyway, so yeah, I mean, like the whole buy hole and all that stuff, like it's still happening. It hasn't ended. And that Fidelity one, hold on, let me see. The Fidelity buy up right here. You see that green bar? That's been like that for the whole year, whole 3 years worth of GameStop trading. But yet the price keep coming down, right? Why? Why is that? It just makes no sense. And also too, the fundamental is a lot better, and yada yada, right? So we know all that. All right. Well, it's pretty good length of time that I've been here. We just hit the 60 minutes mark here. I do appreciate everybody jumping in. I know some of you just jump in right now. I apologize. I'm only planning to be here for 40 minutes. So, yeah, I hope you learned something. You know, there's a lot of things going on here to be wary of, and you know, the thing that is top of mind is this yield chasing frenzy over here, right? So it's something to keep an eye on. I'm not saying it's going to happen immediately. So this time, I mean, this thing takes time to, kind of come to fruition when, remember, the Fed just raised the rate about 6 or 7 months ago, right? Or even 8, 9 months ago. So very, in under a year. And so, it takes close to a year or a year and a half for that rate hike cycle to play in the market, right? And we have not seen the unemployment going up substantially yet. It's coming. You've heard of Citibank telling their worker to take the bonus and then just leave, right? You've seen, tricks like that those big companies is trying to get rid of people, as many people as possible, as quickly as possible, right? Because they're preparing for this type of thing where, the recession is coming, and you have people like Jim Cramer telling you that recession is over. So, and then you have people over here telling you to buy into NVIDIA at this price, right? And then you have people more enthusiastic about, Tesla, because of that humanoid robot thing, right? But in the meantime, you have Tesla car being recalled. 2 million vehicles been recalled because of the self-driving test or whatever, right? And so, those type of thing, just keep an eye on that. Again, I'm not saying that the NVIDIA is a terrible company. I just think that it's way overvalued. And even if it gets to the $600 a share, I would jump out of that because it's not sustainable. Especially with the economic downturn that we have, it's going to experience in a minute. Now, the CEO of NVIDIA has been cashing out shares left and right. Nobody say anything about that, but if somebody were to sell a couple thousand shares worth of GameStop in order to, pay tax and stuff like that, oh yeah, insider is selling, right? Again, they don't tell you that forefront when they want to pump up some a company in front of you, because mostly they own it, right? 67% own NVIDIA in terms of institutional wise, right? Anyway, sorry, keep babbling. Thank you again for great show. Oh, thank you, Lena. Appreciate you. I know you're my number one fan, but you don't count because I talk to you all the time. So, all right. I'll see you guys. I appreciate all of you. I will come back tomorrow.